Well, greetings. I've said the use of accounting is not limited to business world, and virtually everyone engages in a form of accounting. Be it mama mboga, be it children when you send them to the shop, anyone who is in the business of exchanging money is involved in accounting in one way or the other. Now, there is a distinction between accounting and bookkeeping. When you are recording the transactions of how you have used the money, be it in an exercise book, be it in a journal, what you are doing is bookkeeping. Now, accounting in itself is the process. It is an art. It is a science of recording, classifying, and summarizing the financial information and interpreting the results thereof. So anyone can record. It is clerical. But when it comes now to the interpretation, you need the knowledge of accounting. So financial accounting in itself is for professionals. So that's the difference between the accounting and bookkeeping. And accounting is a system. I've said it's a science. So as a social science, it lends itself to its analysis as an information system. And that's why I'm talking about the accounting system. And a system has three important attributes. The first one, it has a basic goal. Of course, the goal of preparing the financial reports is to provide information for purposes of decision making. Secondly, any system has clear and well-defined elements in form of people and equipment. So accounting will be guided by what we call the generally accepted accounting principles to ensure that we stick to the clear and well-defined boundaries. And then accounting has the typical, what we would call the typical attributes or activities of a system. Any system will have input. So we have the data that we are collecting. The raw data will be classified and analyzed. So we are processing. The analysis is the processing. And then we'll be preparing the final books of accounts, or what we call the financial statements. So that will be the output. So just like any system, we are going to have the input, the process, and the output. Now, accounting can be broadly categorized into three. I've defined what financial accounting is. So this is the analysis, classification, and recording of the transactions, and ensuring that what we are recording is the economic activities. So we don't just record. Anything that doesn't have an economic value is not an economic activity. We'll be recording what has an economic value, can be measured in money form. Then you go to management accounting. Just as the word goes, management accounting is the accounting for managers. So management, more than often, needs information to help them make informed decisions. So the information that they collect from the accountants is routine in nature. Routine to mean they can even get this information in hours. For example, Safaricom will be able to tell you how much they are making in 1 second in either voice or data, not 1 second, 1 minute. So they can rate, they have broken their activities into 1 minute. So the manager who is managing the voice section can easily tell in 1 minute we are able to make this money. So you can see how serious it is. Management accounting can be broken in seconds, hours, weeks, months, quarterly, semi-quarterly, or even annually. But we don't advocate for a longer time because managers are supposed to be doing impromptu checks for decision making. Then we have cost accounting. And cost accounting is for making the budgets. And we always compare the actual. A budget is a financial forecast. So you are like a prophet. We have the year 2022. So you sit down and prepare a budget saying, this is what we are going to consume. So these are the resources that we need now. When you are doing that, you are budgeting. What helps you budget are the standard costs. After you incur the cost, you now get the actual. So that comparison of the standard cost and the actual cost is what we are calling variance analysis. So it is in the variance analysis that you'll be able to say the company made a profit or it made a loss. These were the gaps. This is how they would be corrected. So cost accounting is also accounting for managers. Again, it is routine. We don't have to wait until a whole year elapses. So managers can ask for monthly reports. They can ask for weekly reports, and this will help them in making informed decisions about the budgets and what they tend to incur. Now, the economic transactions or activities that you are talking about can be categorized into two. We have what happens within the business. That's what we call the internal transactions. And we have what happens outside the business. I want to introduce the users of the financial accounting. So those who use the information internally are the internal users. And the internal users, we have the owners, we have the managers, and we have the employees. Of course, the owners need to know how the business is performing. Are they running at a profit or a loss? So the accountant or the accounting information will help them judge whether the business is headed where they desired. Managers will need this information to help plan, monitor, and of course, make the informed decisions to prepare the business towards making a profit. The reason why you will start any business is to make a profit. It is two ways. You can make a profit through minimizing the cost. For example, if you realize that you have a lot of casual workers and they are unproductive, you can cut down on the number of the casual workers and instead save that money. So management will require that information. Not many employees will be interested in the information, save for those who work in the accounts and the finance department. But the reason why an employee will need this information, we are in an era where a business is making millions of profits. Then in a couple of months, they head on a nosedive and they close down their business. A good example is the retail outlets. Who thought Nakumat or even Tuskys will go down? Nobody thought, isn't it? But because of poor corporate governance and what we call the bad supply chain practices, we saw those big or the giant supermarkets going down. So employees should be keen on the financials. Someone who had seen the financials of Tuskys would have already known that they have a lot of debts than equity. Equity is what belongs to you. Debt is a liability. If your equity is less than 50%, you should now start being worried that that is not your company. The person who is having the majority of shares is the debt. And you see the debt can be collected by the owner anytime, especially if the time of paying the debt is already due. So that's how the information is used internally. Managers, employers, not employers, employees, and the owners. Externally, this information will be used by nearly everybody. But let us narrow down to these users. We have the prospective investors. Someone will be interested in buying your shares only and only if you are making a profit. I haven't seen a situation where people run to a company that is making losses. The reason why Safaricom shares were subscribed in 2008 is because they were the most profitable company in East Africa. So everyone, of course, will want to associate themselves with success. Then lenders, also the financiers or the givers of credit. They'll be interested in how are you performing. Would you give someone who is running bankrupt your money? How will you be paid back? So you need the accounting information to know that these people are solvent and they are not becoming insolvent any sooner. So they'll be able to pay back. Then we go to the suppliers. Same case. Just like lenders, suppliers will be giving you goods. They want to know your creditworthiness. The very reason why Tuskys and Nakumatt went down and other supermarkets are also equally affected is because suppliers keeps on giving you the supplies, thinking that because you are doing business, of course, if you are supplying and whomever you are supplying to keeps on coming for more merchandise, it means that they are selling, isn't it? They are selling it. So suppliers need to know, well, you are selling, where is the money? Most credit contracts are for 60 days. Are you able to honor your debts as and when they fall due? Right? Then we need to produce. To what extent are we going to increase our output with? We go to customers. Now, most customers, of course, again, like employees, as long as the goods are outside there, they won't be interested. But the customers that I'm talking about here are the industrial consumers. I'm the one who is manufacturing. Let's say Mabati rolling mills. I cannot keep on manufacturing Mabatis, and we have different varieties without knowing the kind of the customer, isn't it? So the meeting will end in, once it ends, just log in the same portal. So what I'm saying is, you'll be interested in knowing how are my supplies, so that how are my customers, or how are my products being consumed, so that you gauge to what extent you're going to produce. You don't want a deficit. Again, you don't want oversurplus. Especially if you are dealing with perishable goods, you should worry because they can be damaged. Then you have the tax authorities and the government. You know, the taxman will be interested in the returns that you are making so that they collect the 30% corporate tax. Then the government, of course, is in charge of the policy. So they'll be interested in knowing whether you are complying to the generally accepted accounting principles and to ensure that the operating environment is okay for every competitor in the industry. Auditors also need this information. Auditors are accountants in nature, but the work of the auditor is to, we call them gatekeepers, is to ensure that we don't have unnecessary errors and frauds. So an auditor will get the accounting statements and check whether they give what we call an independent opinion on whether the books of accounts were prepared as per the statutes or the requirements of the generally accepted accounting principles. The public will also be interested in how the company is performing because of things like CSR, corporate social responsibility. We know most companies, when they break even, they start supporting the community around them. The only way that this information will reach the public is through the financial statements. Well, we are talking of the financial statement. This financial statement, because of the magnitude of information that we are sharing and the number of users, we need to ensure that our statements are such that they are serving the purpose. If they are so sophisticated, they won't be understood. It will be a waste of time and energy. Also resources, because you're involving qualified people. So the following are the qualitative characteristics of financial statements. The first one is understandability. In fact, this information should be so simple in the manner that it is presented, so that anyone, even that person who didn't attend any financial accounting class, will be able to make will be able to make a decision out of the information. Secondly, they are supposed to be relevant, should be free from errors, should be complete, and it should not be biased. Now, the biasness, unless now you are a qualified person, but we expect that the way the information is presented is in a manner that is dependable. I can easily check the total assets. We know that these are the resources that were tied to the business. I can easily follow through and see your total liability. I can see whether you have loans. That's what I'm calling relevance. Then this information should be presented in a manner that is reliable. So the information must be free of any biasness or material error, and therefore it will not mislead the users. It will not mislead both the professionals, investors, and the general public, because they'll be relying on this information to make a decision on whether to put the cash in the business or not. This information must also be comparable. You'll be looking at the principles and you will understand this deeply. Comparability is where I can take the first quarter of 2021 and see how the business performed and be able to do a trend analysis of how between January and March in 2022 we are going to perform. That's why you see the banks saying quarter one of 2021, we made a profit of 60 billion. Quarter one of 2022, we are able to make a profit of 68 billion. So we have an increase in 8 billion. That is now the comparison we are talking about. So this information should be compared or comparable. The way it is presented, anyone can pick, and most financial statements are prepared in running 3 years. For example, we'll be having 2020, 2021, 2022, or 2019, 2020, 2021. So that someone can easily make an informed judgment by comparing the 3 years. Let's say 2020, we were in Corona. 2021, we started resuming. So we expect 2022 will be better, except that we are in the political mood. So, but economically, we are expecting to have a positive. Then timeliness, especially the management and the cost accounting. I say this information is used for decision making. So if the information is delayed, well, managers will not be able to get there or make the decision in good time. And then the company will not benefit from the information. So timeliness becomes very important. Financial statements are supposed to be prepared annually. Now, the business can decide to do quarterly reporting, but what the standard or what the law requires is that you present your financials every year. Of course, the reason is the government is also an interested party. They want 30% from your net profit. Any question? Well, we said that financial accounting is a science. It is a language of business for business people. Now, as professionals, we are guided by what we call the accounting concepts, principles, and assumptions. And these are basically the validated tests that have been done by experts. And after a lot of experience, they are able to determine that if we do this, this is what will happen. So those are the concepts. So the concepts will change into law. All the assumptions will change into concepts. Concepts becomes now the law, or what you are calling the principles. Now, I have 4 assumptions there. The first one is business or the economic entity. This is as simple as the business and the owner of the business are separate entities. There is no better way that I can explain that. You and your business are different entities. I've seen in most cases, especially, let me give an example. You are a shopkeeper. Of course, it is your shop. So we cannot reprimand you on how you run your shop. It is your shop, isn't it? So at times, you take a 1/4 kg of sugar for your own use. You don't document it anywhere. Then you say after a while, you take salt. You will take a small quantity. So you make sure that you take the smallest quantity, but you don't document it anywhere. So at the end of the month, when you are doing your books of accounts, again, you make another blunder. Say you have opened the shop in your premises, so you don't charge yourself rent, you don't pay yourself a salary. Let's say you started your shop with 10,000. At the end of the month, you have 15,000. So you go smiling to everyone that your shop is profitable, you made a profit of 5,000. The accountant will tell you, hold, pay yourself a salary, assume you are on a rental premise, pay rent, so deduct that money. Deduct the sugar that you took home, deduct the salt that you took home. Are you still profitable? That's why